Welcome to the Santam Ensure Your Future Money Bootcamp with me, Maya Fisher-French.
And me, Mapalo. To give our listeners a bit of background, we have been working with Santam staff members where we take them through a money bootcamp.
And last year, after seeing the amazing changes these individuals went through, we realized there was an opportunity to take this money journey to a broader audience. So thank you very much to Santam for sponsoring this podcast.
Now, last episode, we focused on saving for shorter-term goals. But what about those medium-term and longer-term goals, Maya? Like your child's tertiary education in 10 years' time, leaving a legacy for your child. Maybe you want to start a business one day. How do you start investing for that?
I think, Mapalo, we spoke in the last podcast about having goals.
Yeah.
And I think it has to start with a goal. You need to know what it is you are saving for and what amount you actually need. So what are you going to need in 5 years' time? And I find for a lot of people it's difficult to do the maths. There are a lot of calculators out there. But sometimes one of the ways to think about it is to think about it in present time. So, maybe what is it going to cost to send your child to university, for example? Now, I've got my son at university at the moment, so I know the fees. So if you have res and you have tuition and res, you're looking at about 150 a year, 150,000 a year. So, but what will that 150,000 be in 10 years' time? So you can pretty much double that, by the way. It'll be probably 300,000 a year because it's going to...
A year?
Oh, yeah.
So if it's a 4-year degree,
So right now, a 4-year degree will cost you 600,000
No,
rand.
Maya. That's more than $500,000.
More than 500,000 for a 4-year degree. That's obviously sending them to res as well.
Yes.
Accommodation. If they're staying at home, you're saving a bit of money. So you've got to think about that.
Still there's transport and all sorts of things in between.
But I mean, it's probably going to be double that. It'll probably be about 1.2 million.
Oh, no.
But remember, inflation's gone up. So your salaries have gone up. Everything's gone up along with it. So you can't think about, that's why it's difficult for people that when they hear that their number, they kind of freak out.
Yes.
But what I just say is, okay, so say it's 600,000 for a 4-year degree. That means, say your child's 8 years old, they're going to go to university in 10 years' time. You take that, you say, well, that's 60,000 a year. That means I need to be saving 5,000 Rand a month. So if I'm saving 5,000 Rand a month, I'm hoping that my investment will grow by more than inflation so that it'll keep up with the increase in costs of the university. Does that make sense? So sometimes it just take the number that you're targeting in real terms, what it is today, and then, start saving. Work it out on that amount. How much do I need to be putting away every month now to hit that goal in the future, but then hope that the growth, or make sure, and that's what we want to talk about, where to invest to get that growth, so the growth at least keeps up with inflation. But Mapalo, this is also why, when you get to having children paying for kids' education, you don't want debt. You don't want car finance. People need to understand that often it's a decision between educating your child or paying off that car.
I would choose my child any day. Any day. And I know, obviously, every parent wants to do that. But normally we don't look at the cost and, what do we have to give up or, look at and say, what the opportunity cost here. I know some parents also who say, I've always desired to drive this German car. Like, it has been my dream. And to them, again, that self-esteem, that, the psychology of money, again, coming back to us to say, well, I'm going to drive this car and try to figure it out. But once you start doing these numbers, it's quite scary for me. Like you mentioned 600,000. I said, what?
Yeah. I think this is it. We don't understand what the stuff costs.
Yeah.
And then you come along and you realize why people are really struggling to send their kids to university, because this is what it costs.
But Maya, it's all too much. Like, let's just be honest. It's all too much. And now they are going to private school. I'm trying to save for university. I have to drive. I have to pay a bond. It's all quite a lot, though, for one person. So you're looking at, say, for example, 5,000 bucks, and someone is looking and listening to this and saying, where am I going to get 5,000 bucks from?
Because I'm already paying the school fees now.
Yes, and the school fees now is 5,000 Rand.
And then every month. So I think that you also have to be realistic and say, well, am I trying to save for the entire tuition fees, or am I just trying to get to a point where I can alleviate some of the pressure. And I think that's what's important. I don't try, and I mean, you and I were chatting about this earlier, where I think with us, what we do is we just try and make sure that we've got enough to cover some of the costs so that we're not always under pressure for that monthly bill. And I think that's more realistic rather than saying, well, I'm going to save all 600,000 Rand the day they start university. Say, look, I'm going to at least have 100,000 or 200,000 saved by then so that I can at least top up what I'm short on my monthly.
100%.
Well, you know what I'm short on monthly.
That sounds more realistic. That sounds...
So I can see you looking more relaxed now.
It's giving me so much more comfort putting it that way. And I think that's just a more realistic way of looking at things. And for me, I think that's why it just makes me so happy to talk about my favorite investment vehicle, tax-free savings account, as one of the ways in which you can save for tertiary education for your child. Can we talk about that, Maya?
Oh, I love this as well. I've always said I think I should be the poster girl for tax-free savings account, but I think you and I, we should be the poster girl twins because we really do love tax-free savings accounts. And I think the starting point is one of the things that, I find Mapalo, a lot of people don't understand is growth. So I get a lot of people saying, how much interest will it pay me? And it doesn't pay. You mustn't invest for interest. So maybe we should just take a step back and explain interest. So interest is when you put your money with the bank and the bank says, I will give you, 8% or 7% or 5% every single year and it's guaranteed. That's just what you will get. Yeah. Okay. Growth is when you invest in something and it grows in value. So I think for most people, they understand property. They hope like if I buy a house for $1 million, I'll be able to sell it for $2 million. Yeah. That's capital growth. And that's the real money. Over time, that's where the real money is made. And the best way to access that for retail investors is through things like unit trusts or exchange traded funds. These are things that invest in the stock market. Yeah. And one of the best ways to do that is through a tax-free savings account. So I think let's be dialing it back a little bit into a few baby steps. And the reason, you wanting to do that is people always say, oh, but Maya, at the moment I can get quite good interest. Why do I want to take the risk of investing in shares in the stock market where it goes up and down? Yes, right now, at the moment, we're in quite a high interest rate period, but it never stays here. Yeah. Interest is the one thing that can really go down. Remember, it went down to 7% bonds and you were getting like 3%, okay, on your fixed deposits. The same will happen. Yes. As the tide changes, as inflation comes down, we're going to see interest dropping again. What doesn't drop over time is growth, because if Standard Bank or Pick n Pay or MTN or any of these companies they keep selling and they keep growing.
And they keep expanding.
Yeah. And their whole drive is to keep growing above inflation, okay? So those are the companies you really want to be investing. And then, of course, you've got this huge opportunity to invest offshore as well.
Yeah, we're going to get to
through tax-free savings accounts. So maybe we should pause for a moment and explain I'm going to hand it over to you to explain what a tax-free savings account is.
Yes. So, Maya, I love tax-free savings accounts. They were brought in 2015 to try and encourage more people to start saving, right? So with a tax-free savings account, it is that tax-free.
Her face is just lit up.
Tax-free. You do not pay any capital gains tax. So, for example, if you were to sell your property right now, there is capital gains. So you bought it for 600,000. Now it's 1.2 million. You are going to pay some tax on that. All right. Then there's no dividend withholding tax. If you have shares and they pay out dividends, there is some tax there. So with everything, the taxman wants something. This is the first time ever where they say whatever you have invested, whatever you've put and you have growth on that money, it's going to go into your account completely tax-free. Zero. We want none of it. How incredible. So for me, tax-free savings accounts are such an incredible investment tool. And I hate the name, by the way, Maya.
It's that frigging savings. It's not a savings account. And that is hurting so many people.
Exactly. So see it as a long-term investment. So I actually call it a tax-free savings investment, not an account, because immediately when people think of an account, you think, oh no, it's a normal savings account. I put money in there, I take money out, that sort of thing. And by the way, some companies do advertise it as such.
The banks. It's a big bugbear for me, is that the banks advertise their savings accounts as tax-free savings accounts. And you know, the problem, and I think I mentioned this in the last podcast, the when you invest in cash, right, and you get interest, your first 23,800 Rand of interest is free a year, which means right now you could put 400,000 Rand into an interest-bearing bank account, and you would get a tax. You wouldn't pay tax on the interest
already.
So why use a tax-free savings account for interest? It is there for capital gains. It is for, and just to give you an idea, I mean, if you're allowed to put 36,000 Rand a year away into a tax-free savings account, so that's 3,000 Rand a month.
A month, yeah.
If you put 3,000 Rand away a month for 15 years, it will have, and it gets a 10% return, which is, by the way, the long-term average of investments in South Africa. In fact, it's higher. It's at 12%. So it's realistic to say 10% a year over 15 years. It would be worth 1.2 million.
Oh.
Now, you would have had to have paid, you've only put in about 540,000 over that period. The other, what is that, 700,000 Rand would be taxable. It would attract
under
capital gains tax.
any investment vehicle.
Yes.
Yeah.
So for me, it's just a complete and utter no-brainer. I always say to anyone, if your very first investment should be a tax-free savings investment.
Yes.
Let's just throw a savings account out the door. Yeah.
No, absolutely, Maya. It's such an incredible instrument. But how do we not use it? Because, you know, we've kind of alluded to, you know, banks say, oh, no, it's a normal account, put money in. So one of the things that we need to say immediately is that it's a long-term investment. Do not do it with your bank. Make sure that when you're investing in a tax-free savings account, don't touch those funds. At least 15 years, right? At least 15 years. For me, it's one of my goals when we're talking about tertiary education. Both of my kids have a tax-free savings account. I get so excited for them. I'm like, I just look at them. I'm like, oh, look at this 3-year-old millionaire.
He will be a millionaire, tax-free millionaire one day.
Tax-free millionaire one day. Exactly, exactly. So what other ways should you not use a tax-free savings account, Maya?
Yeah, so emergency funds. It's come up very, very often as a being used for emergency funds. Exactly. You do not want to be doing that. You don't want to go and be putting money in and taking out. And the reason for this is that you have two limits. One, you can only put 36,000 Rand away every year. So if you drew out 10,000 during the year, you can't put it back in again.
Yeah, you can't say, oh, well, I
drew out, so I'm putting it back in. So if you've used your 36,000, you've used it up. And then you've got this lifetime limit of 500,000. At the moment, it will probably be raised.
Probably increase,
But the other thing that I find, Mapalo, is that people think that the 500,000 Rand lifetime limit includes the growth on it. It's not. It's just contributions.
It's what you physically will contribute into that instrument.
Yeah.
And it's not capped. The growth is not capped.
The growth's not. So if it gets to 1.2 million, it's 1.2 million. It's not capped there.
Yeah.
It's your contributions. But you know, so SARS has said, or National Treasury has said, well, we don't want to let everybody put all their investments in here because we want some tax.
Yes.
So they've said you can contribute until you have contributed 500,000 Rand. But obviously we're not there yet because it's only been around
since 2015.
2015, so that's 7 years. So we're not quite at that level yet, and we're expecting that lifetime limit to be raised as we get closer to it. Well, fingers crossed. But of course, if you go and you've put 100,000 Rand away and then you draw it out, you've just used 100,000 of your lifetime limit and you can't replace it.
Yeah, that
so
hurts.
I think that's part of why you just need to know that this is really for long-term growth. It's to save you capital gains tax and dividend tax. I think somebody did a calculation, one of the investment houses, you know, if you take a comparison over 15 years between a unit trust, and I want to explain to people how to access these things, but you can take a unit trust that is not in a tax-free savings account wrapper versus one that is in a tax-free savings account wrapper, you will pay 30%, your return will be 30% less because of capital gains and dividend tax.
30%. That is a lot.
So
Double digits.
Yeah. So you really do not want to be, saving, your first 3,000 Rand a month should definitely be going into a tax-free savings account. That's the way.
And I mean, just really going back to the example that you made, if you're going to need 150,000 a year and you're putting away 5,000, at least if you do have that 5,000 to put away, make sure that that first 3,000 goes into a tax-free savings account. Then you can look at other options like your exchange-traded funds and unit trusts.
So one of the arguments that people raise with me is whether you should use it for the tertiary education or not. Because they're saying if you're using it, so like I've got a tax-free savings account in my name.
Yes.
And I'm using that for my retirement.
Yes.
It's a brilliant retirement fund. I mean, you get to retirement. So we're definitely going to be doing another podcast on retirement, right? That the next one that follows will be on retirement. But for me, my strategy is, well, I've got my retirement annuity, but there's rules around that. But when I get to retirement, I want to have this big lump sum that's tax-free.
Oof.
So that's one of my big goals. And I know I haven't used my children's education funds. I haven't used tax-free for them. But remember, they're already in their 20s.
Yes.
So when they came out,
they were already...
they had, but I had discretionary investments for their education.
Yes.
So they were outside of tax-free savings accounts that didn't really exist. But some people say, well, you don't want to use your child's allowance for tax-free savings accounts for their education. How do you feel about that?
You know what, Maya? For me, it's such a brilliant investment vehicle, number one. And the fact that it's tax-free. Yes, I'm saying that, okay, it's for their education, but I'm hoping that I won't have to use it for their education, right? But I know there is something that's there and it's sitting for them to either access at when they go to university. Hopefully, I won't need it. But for me, it's a no-brainer if I don't need it, right? So let's say it's a perfect world where actually I don't need to use their tax-free savings account as a form of for an education fund. Then imagine then they leave it. Then let's say Moilezi says, you know what, I'm just going to leave these funds until I'm 30. Oh man, can you imagine, Maya?
Absolutely, yeah. So, I mean, that is so my sons, I've got tax-free savings accounts for them and I'm contributing every month at the moment because they're still students. Obviously, my great hope is that one day they'll take it over.
Yeah.
But I know a woman who actually started putting money away into the tax-free savings account and she said to her children, I will continue to contribute to it for as long as you do not touch it. How clever is that?
Wow.
Because, of course, once your child turns 18 and if it's in their name, they can actually access it legally.
But that's why it's so important to actually start having conversations about personal finance, about money, so they know what treasure really this is for them at the end of the day. That, you know, if they want to buy their first house, if they want to move overseas, whatever it is, they have this great investment that they can. And another question why people say, even if you don't use it for their education, let's say you're just contributing so that they have this massive lump sum when they're older. Some people say, but you're taking away their 500,000 limit. I say, would you rather give someone like at the age of 25, starting their lives like most of us did, to say, oh no, I'm going to start with my 500,000 limit. I'm not going to start contributing. Or you want to give them 1.2 million?
No, I don't. That argument I never understand.
I mean, never ever understood.
Would you like to give your child the gift of compounding? Yeah. So I think I'm giving my child the gift of compounding. I'm not trying to use up. And as I said, I think that limit will be lifted as well.
Yes.
I mean, over time we should see that.
Crossing my fingers for it. I definitely use my tax-free savings account also to supplement my retirement, and I've done the numbers. It's such an amazing vehicle.
It is an amazing vehicle. I love anything that I don't have to pay tax on. So we definitely want to unpack that a lot more for our retirement podcast,
yes,
which we're going to do next after in the next episode. But let's take a step back, because a lot of people say, Maya, where do I find these tax-free savings accounts? And as you've said, the banks are great at advertising the fixed deposits. And they say, great, we'll give you a fixed deposit. No, don't go for that one.
No.
Some of the banks offer the actual investment ones. I know FNB does,
yes,
which goes into unit trusts. And I think Standard Bank, they all do
Standard
have
Bank,
a range that are linked to investments. But maybe we should unpack a little bit, where do you find tax-free savings accounts?
So most asset management companies do have a tax-free savings account, and that's what I prefer, right? And there's so many of them. I think sometimes it's analysis paralysis. There's so many of them. Would you want to mention them? No?
Well, I think let's start off. So there's two sides. You've got unit trusts and exchange traded funds.
Yes.
And I sometimes think, again, we complicate these things unnecessarily. So I would rather say to listeners, there's two types of investing. One is active management. That is when you go and you invest with a fund manager who's actively making choices and decisions about what to invest in. And a good example would be something like 91, Alan Gray, Coronation, Stanlib, all of those companies, Suntum Investments as well.
Yes.
So Sunlum Investments. So you've got a whole range of companies out there that hire professionals to invest on your behalf, and they're called asset managers, and they make active decisions about where do we think it's MTN or Vodacom, which of those two do we think are going to be a better return. So, and for that you obviously have to pay them a fee. So these are higher cost products. Then on the other hand, you have things which are exchange traded funds, normally, which we call passive investments. And this is where you're just getting the average return of the market. So nobody's really going out there saying, let's pick this share over that share. You're just getting the average. And now Satrix would be a very good example of that. And they tend to be lower cost. So those are really the companies that you can go to. But I think if you're going and you're wanting to invest, go ask the company that you're with saying, show me your tax-free savings account options. Yeah. That's the one I want to invest in.
Yeah, absolutely. And with that being said, Maya, I mean, now you know where to go. Then you get there and people say, oh my gosh, the number of funds. I don't know which one. And I see people a year later, they haven't started their tax-free savings accounts because they just didn't know which fund to choose. How do I go about choosing a fund or two funds at least?
So one thing I like about most of the fund managers, I mean, Satrix, I've seen it on 91, Alan Gray's got a very small range, is they talk about their core range. So if you go and you choose their tax-free savings account options, they actually give you a kind of core range. They say, just choose from these. And I like that. I think it simplifies it. From me, if I look at what I've got my money in and my kids, I have to, I'm with Satrix. All of mine is with Satrix. I like low-cost investments. But I think that you've got something like the Balance Fund, which is great because it gives you bonds, it gives you cash, it gives you equities, it gives you offshore. It gives you I think as a starting point, it's a nice... any of the people we're speaking about, even the asset managers have a balanced fund, and they're allowed to. They all have a balanced fund, and they're allowed to invest.
That's what I always say: choose a balanced fund. Start from there, then, build up your knowledge and come back to it, But just choose one.
Choose one. Just go and do it and start putting the money away. But the other thing, which is really amazing, is that you can access the entire global markets through these products as well. Exactly. So you can go, all the asset managers have an offshore fund, right? Local offshore. So you can choose it as a tax-free savings account and the money is actually invested overseas. So you get your money back in rands. You don't get it back in dollars, but you've got exposure to the global markets. Satrix S&P 500 gives you the American market. The MSCI World Index is 1,300 companies in the world.
Yeah.
And you can do that for like 100 200 Rand a month. It blows my mind.
Yeah. And I mean, Maya, with that being said about where to invest, a lot of the times people don't go back, right? They don't go back and review their investment because, number one, you haven't started learning about personal finance. You haven't really gotten into actually what is a balanced fund. Maybe let me go read a fund fact sheet. Then people just kind of leave it like that. And one of the things I really love about a tax-free savings account is the fact that you are not restricted to the percentages like you are in a retirement annuity to say, okay, you can only invest in equity. You can really go really aggressive on your tax-free savings account. But the thing is, just keep on learning. Pick one, number one. Then from there, keep on learning and know that you're not restricted in terms of where you can invest and how you can invest.
I think that's it. To me, it's just start. Go find something. If there's a company we've mentioned that you're familiar with, go onto it. Start. Open the balance fund. Start there. Just start putting a little bit of money away into that and just start letting it grow. And I think that's a really, really good starting point. And then if you want to, maybe you can add some more offshore if you wanted to. What's quite interesting, of course, everybody wants offshore now, Mapalo, because offshore has done so much better than South African equities because the rand has been weak. Our markets haven't grown. Do you know there's a big shift? all the asset managers, and there is one particular investor who is very vocal on social media about how terrible South Africa is.
I know him.
And yeah, you know who I'm talking about, and how everyone should invest offshore. And do you know what his latest newsletter says? Invest in South Africa. Yep.
That's a turn.
That's a turn. So be careful also getting too caught up in the offshore story right now. South Africa has come out of a really bad time. I think there's obviously a lot of positive hopes about the new government structures and all the rest of it. But interesting that somebody who's been that negative on South Africa, as the latest newsletter has said he's starting to see opportunity in South Africa. So I think, you know, don't dismiss South Africa either when you're looking at these funds. That's why, again, a balanced fund makes sense. You don't have to think too much. It's got offshore, it's got local, bonds, cash, you know, property. It's a really nice blend.
Yeah. So what do you say to people who really drill into, I mean, you spoke about unit trusts and exchange traded funds. There are people who will say, no, exchange traded funds are the only way to go. And other people will say, well, unit trusts, they just want to make money off of us, that sort of thing. What is your...
You need to look at the returns. So always look at their returns that they show, and those returns are showed after costs. And I do have to tell you, I've been looking at a couple of funds, you know, active funds versus Satrix, for example, and you know, the passive funds, the index tracking funds like Satrix are doing pretty well in comparison. So, you know, I'm not going to get into the debate, but I think you need to look into it and see, you know, is this fund manager delivering, and are they giving you something that you can't get with a tracker fund? And sometimes that can be these multi-asset classes where they can ramp up and down they can move between bonds, and they can move into property, and they can move when they see value. And if they're able to do that consistently in a way and deliver the returns that justify the fees, then obviously it's worth looking at. 100%. But I mean, to me, I just think we've flooded people with too much choice, and people stop investing because they're overwhelmed by choice. So I'm just like, keep it simple.
Yeah.
Just go, choose whatever you choose, put the money in, just make sure the fees aren't too high and go for it. Which brings me to a contentious point. Endowment products for education.
I hate them.
Okay. So
I can't help myself.
So there's like about a lot of people who are never going to do a podcast with us ever again for what we've just said.
Yep.
You know, we've spoken about saving for education. Mapalo and I both save for our kids' education. I save for mine purely in unit trusts, actually it happens to be a Satrix, but with, in investments outside. I don't have a special wrapper. I don't have an education plan or builder or whatever you want to call it, because I'm not convinced the fees on those things and the tax treatment of them is in my benefit.
And I think, Maya, there's something very important about language, right? Because it pulls at your heartstring when you hear education policy, because you want to do the best for your child. But if you look at the costs, the fees that are in those endowments, no one should have an endowment. And I mean, the way they are sold is that they're tax-free. But actually, if your tax bracket is below 30, you should not be in any endowment whatsoever.
So I want to explain the tax thing. So an endowment is taxed in the hands of the investment company. So the tax rate on an endowment, I think, is 30%. So it's a great product for a high net worth individual. So if somebody has a tax rate of 45%, for example, and they've already used up their tax-free savings account. I mean, do you see what I mean? Why go for an endowment when you can go for a tax-free savings account?
Absolutely.
Tax-free savings account is truly tax-free. An endowment, the capital gains tax, dividend tax is all done at 30%, okay, within the company tax. It's taxed in the hands of the investment company. So that makes sense if your tax rate's at 45%. But if you're sitting at 25% tax rate, which many people, it's marketed to, right? It's marketed to people who have lower incomes, who are being told to buy a policy for 300-400 rand a month. And for them, they're paying more tax than they should, and they're paying often very high fees for the structure. So I agree with you. I think be very careful about falling for anything that says education policy. You can just go and put this open up a tax-free savings account, or even open up just a regular account with a unit trust or an exchange-traded fund and put the money away there. I just don't see the benefit of that additional cost.
Yeah, absolutely, Maya. There's just no benefit for it, investing in an endowment policy. And so sometimes people say, okay, Mapalo, I hear you talking about this. How will I know if it's an endowment?
Okay, well, if it's an insurance-backed product,
yes,
that's,
And normally they will say, it matures in 5 years.
That's the other thing, of course. They have time frames.
Yes.
So they usually are a 5-year or a 10-year product. And that's another thing, is if you break it. So say, for example, you need the money. Life changes, something happens, and you really need that money. You will pay a penalty because you're in this.
Penalized.
Yeah. Or if you can't continue to contribute, you could also be penalized.
Imagine I get penalized for saying, well, I'm going through a tough financial time right now. Oh, well, let's penalize you for that.
I know. You can see Mapalo and I are not our favorite. And there's a lot of people listening to us going, oops, I've got an education plan.
And then what must they do then, Maya, if you already have an existing one?
It's very difficult, because if you cancel it now, you're going to pay those penalties. So I think just
Maya,
keep it till... Have you done the maths on that?
I've done the maths on it, because either way, it's built in. Those fees are built in. You're going to pay them either way. So yes, you might be waiting. Let's say you're in your first year and the penalties are high, but you are still going to pay those fees at the end of the day, isn't it? Because it's built into the product itself.
Yeah, I think it's worth doing a little bit of an analysis. I mean, certainly I'd always recommend working with a financial advisor, but that's probably the person who sold the product to you.
Well, not that financial advisor.
Yeah,
find someone
maybe
else.
one who doesn't use endowment policies for education plans. But yeah, I mean, you do need to look at it and say, well, how much am I going to lose if I stop these contributions? And then maybe you do stop the contributions, but then you start again on a lower cost product.
Yeah. Maya, you know, most of the time with our podcast, I end up asking questions for myself, because probably someone else is asking the questions. You've made me really think about the tax-free savings account that I have for my kids, and it's in their names. If I were to put a bit extra, because what I've done, I do have a separate account where I put, it's not a lot of money. Once in a while, maybe it will be 1,000 consistently. Then when I do have bigger sums, I'll put that in there. Would it be wiser to open up a unit trust, for example, to start saving for the longer term type of education?
Yeah, I mean, that's what I did. I've got two. So my kids have two accounts. One is outside.
And is it in their names?
It's both in their names, yeah.
Okay.
So one is in their name outside of the tax-free savings account, and that's the funds that I've been drawing down for the educational costs. And then I've got one that is just a tax-free savings account in their names, and that's the one that I'm thinking longer term for them.
What do you hope for those funds?
For their tax-free savings accounts,
Yeah.
that's my child legacy. So everyone wants to leave a legacy for their children, and they all think they're going to do it out of their retirement fund. You know what? You're going to need every last cent for your retirement. You're not going to have any extra money. We'll definitely talk about it in the next podcast, to give your child a legacy. You can give your child legacy by starting to put, even if it's 200 Rand away a month, now into a tax-free savings account. Then by the time they get older, that's the legacy you can leave them.
I love that. Let's talk about offshore, Maya. I mean, we've spoken a little bit about, the person having a turnaround. Say, SA Inc. has value. How do you start investing offshore? Because I think the misconception is you need quite a lot of money. You need to be a multi-millionaire already to start investing offshore.
So you've got two ways. One is you can invest in local funds that invest on your behalf overseas. So if you put in rands, they invest it overseas for you. And then when you want it back, it comes back in rands. You don't need any tax clearance or anything for that, right? You don't have exchange control approval, nothing. You can just do that. And that you can do through a unit trust. You can do an exchange traded fund. You can even take it out as a tax-free savings account. So, for example, my kids, I have some of it is in the MSCI World Index. Okay, some of their investments are like that. But you may be somebody who feels that you want to build assets offshore, properly offshore, that you want to have funds that are completely and utterly outside of South Africa. For whatever reason, you may feel one day you're going to retire overseas, you may educate your children, you may just be anxious about the future of the country. Everyone has 50 different reasons as to why they want to do it. And there are a lot of products, again, the local companies like 91, like Alan Gray, all of those coronations, they all have those funds available overseas. So you can go through them, and I would highly recommend you do use a South African-based company because of tax and all the other compliance that you have to meet. Also, try and go overseas and try and open, as a South African, any investment. They are not interested because of our grey listing and all these things. So it's generally easier to use a local company.
Yes.
I have offshore assets. I have an investment properly offshore. And it is part of my total retirement strategy, not that I'm going to live overseas when I retire, but it was something I wanted to do. I wanted to have different types of exposure. And, you can invest. There's a lot of these products you can start with, generally about 50,000 Rand. So you do need a lump sum to start it. They don't generally do debit orders because obviously it's expensive.
Yes.
You can put it over as part of your, you get R1 million a year discretionary allowance that you can put offshore.
I mean, most people don't have $1 million. So for me, it was such an interesting topic because we discussed this and I told you that, I'm interested in really taking my money offshore now instead of just using my tax-free savings account and exchange-traded funds. And we spoke about it. So another thing that I wanted to highlight about this conversation when it comes to investing offshore, if you are someone who's interested in investing offshore, you don't have to have the 50,000 bucks immediately or the 100,000 or whatever that minimum is. So one of the things that I have done, and I've set a goal for myself that by this time next year, I will have the 50 or 100,000 minimum so that I can start investing offshore. So you can save money to invest.
Yes, we spoke in the last podcast, we spoke about saving for the couch, but you could actually save to invest.
Exactly.
But also you can open up locally a foreign denominated bank account, right?
Yes.
So, I mean,
yes.
FNB Global. FNB Global, all of them have it.
Yeah.
But FNB Global, I just think came to mind. You could put money into the dollar account every single month until you have 50, the equivalent of 50,000 Rand in dollars. Because if you're worried about the currency, so you're thinking, well, the currency may be weakening whilst I'm saving. You can keep putting your money in there and then you're able to transfer that offshore. So there are definitely ways to do it.
Yeah. No, I'm very excited about that. And, I love the journey that I'm on because the things that I speak about and the things we speak about are the things that we're doing. So for me, it's an exciting part to start talking to people about investing offshore and how it's going, the ups and downs of it. And I can't wait to share that.
Fantastic. So I think, Mapalo, once again, we've given people endless food for thought. And we really, of course, encourage you to post your questions, to engage with us through social media on this podcast. So because, it's your questions that actually form a lot of our conversations and get you and I thinking a little bit about it as well.
Absolutely. And absolutely. And Maya, what I've realized is with a lot of questions coming in, you might find that someone else had a similar question. And now, by answering your question, we're answering many other people's questions that they had. But we haven't discussed retirement products, Maya.
That is what we're going to be doing in the next podcast, because that needs its own podcast altogether. So definitely tune in for the following podcast where we're going to unpack retirement products, and how you should be planning and getting to that big number.
Yep. See you soon.